Welcome to Synthetic Alpha AI, where artificial intelligence meets institutional trading. Let's decode the market.
This video is for educational purposes only. It is not financial advice. Trading Forex, CFDs, and synthetic indices involves significant risk. Past performance does not guarantee future results.
Every price chart is hiding a structure that most traders never learn to see. And once you see it, you can't unsee it. Because this isn't about indicators. It isn't about drawing random trend lines and hoping they hold. It's about understanding why price moves the way it does, before it moves.
By the end of this video, you'll understand the framework experienced traders use to read almost any chart on almost any time frame. And near the end, we'll cover one mistake that quietly destroys more trading accounts than bad strategies ever do.
Let's start with a simple truth. Price doesn't move randomly. It moves in a sequence of highs and lows that tells a story. That story is called market structure. Most beginners look at a chart and see chaos, candles moving everywhere, prices rising, falling, and reversing. But once you know what to look for, that chaos becomes readable, almost like learning a new language. And once you can read that language, you stop guessing.
Market structure is built from just two things: swing highs and swing lows. A swing high is a point where price rises, then reverses lower. A swing low is where price falls, then reverses higher. That's it. Those two building blocks create every trend you'll ever see. When price creates a higher high and a higher low, the market is generally in an uptrend. When price creates a lower high and a lower low, the market is generally in a downtrend. Simple enough. But this is where most traders stop learning. And that's exactly where the important part begins. Here's what almost nobody explains clearly. Market structure isn't just about identifying highs and lows. It's about recognizing the moment that structure changes. This is often called a break of structure, or BOS. Imagine an uptrend. Price keeps making higher highs and higher lows. Then something changes. Instead of continuing upward, price breaks below the most recent higher low. That break can be an early signal that the existing trend is losing strength. Notice the word can. It isn't a guarantee, it's information. And that's an important distinction. But this still isn't the biggest mistake traders make. The biggest mistake is treating every tiny movement as a major structural shift. Markets move in layers. There's structure on the 1-minute chart, the 15-minute chart, the 1-hour chart, the daily chart. A break on a small time frame may be completely insignificant on a larger one. That's why many traders exit good trades too early. They're reacting to noise instead of meaningful structure. Experienced traders usually begin with the higher time frame. Then they work their way down. Think about reading a book. You wouldn't understand the story by reading one random sentence from the middle. You'd start with the chapter, then the paragraph, then the sentence. Market structure works exactly the same way. Now let's connect this to support and resistance. Those swing highs and swing lows aren't just points on a chart. They're areas where buyers and sellers previously made important decisions. When price returns to those areas, it isn't magic. It's revisiting places where strong buying or selling pressure existed before. That's why market structure and support and resistance are really two ways of looking at the same idea. The difference is that market structure evolves. As new highs and lows form, the structure changes with them. And that leads us to another important concept: liquidity. Beyond many swing highs and swing lows, you'll often find clusters of pending orders, stop losses, breakout entries, and other resting orders. These areas are commonly called liquidity. Price often moves toward them because that's where many market orders are waiting. Sometimes price briefly moves beyond a swing high or low, then quickly reverses.
To someone focusing only on candles, it may look like a fake breakout. But when viewed within market structure, it often makes much more sense. It's important to remember that this is a historical market tendency, not a guarantee. Markets are never obligated to repeat the same behavior.
So how can you actually use market structure? Start with the higher time frame. Identify the overall trend using swing highs and swing lows. Next, determine whether a meaningful break of structure has already occurred. Then, study how price reacts around previous highs and lows. Does it respect those levels, or does it briefly move beyond them before reversing? Only after understanding that bigger picture should you move to a lower time frame to look for possible entries. This process won't predict the future. Nothing can. But it replaces emotional reactions with a structured decision-making process.
Think about hiking through unfamiliar mountains. You don't need to memorize every rock. You just need to understand the overall terrain, where the trail climbs, where it descends, and where it changes direction. Market structure works the same way. It doesn't provide certainty, it provides context.
Remember the mistake I mentioned at the beginning? Here it is. Many traders treat market structure as something that predicts the future with certainty. That's the wrong mindset. Market structure doesn't tell you what price will do. It tells you what price has already done. And it gives you a framework for responding if similar conditions appear again. The traders who struggle are often searching for certainty. The traders who last are focused on probabilities and risk management. That's the real value of market structure. Not prediction, context.
Market structure won't make every trade a winner. Nothing will. But it can completely change the way you read a chart. So I'm curious, what surprised you the most? The concept of liquidity? The idea of multiple timeframes? Or something else entirely? Leave a comment below. I read every one. Thanks for watching. Until next time, stay patient, stay disciplined, and trade with Synthetic Alpha AI.